Morning all, and welcome to the market view for Friday the 7th of March 2014. And starting off with the daily chart, we can see that the market is developing a sideways range, and because of this, over the last few days I've been placing the sort of fib retracements on the chart for you so I can give you some indication of where the market's likely to trade to. So with this in mind, let's bring you back up to speed of where we are with the 76% retracements. I'm just going to go to the markup tool and annotations and the fib retracement. Now if you remember yesterday, we drew in the high down to the low and said this is where the market could possibly trade to, and that's precisely what it did. It traded through the 167.64, went to 167.76, and then stopped, reversed, and came back down towards the 62% retracement there. Now the market's showing some resistance here and struggling to actually move to the upside. Doesn't mean to say that it won't, of course, because all it needs is some economic news item that's favourable or geopolitical news to be announced, and the market can drive through these areas. But at the moment it is struggling with the 167.64 area. And it's got this sort of sideways psychological level here as well at 166.50. So the market is range bound at the moment by 100 points. And knowing these resistance and support areas, of course, we can use these to our advantage in the smaller time frames. So if the market's going to move lower, where's it likely to come down to? So we'll just click on the fib retracement tool there. We'll go from the low here, first one across from the right of the chart, to the high, first one across from the right of the chart, and then just click in place there. So the market could trade down today to the 166.72 area and the 166.91. So let's have a look in the smaller time frames, see what happened yesterday in this area. So we'll go to the 30-minute chart. The first thing to notice is the market was stuck in a sideways trading range yesterday until the interest rate news came out at midday, and then we see the market move lower for an hour, and then we get this buying bar come in at 3 p.m. Notice this bar, even though it's a red bar, it's at the DP level, at the psychological level of 167. And also the low of this bar is higher than this low, as is this bar's low higher than this. These are called rising lows, and that's because each low rises above the previous bar. And these are clues that you should look for when trading as well. So we see the market moving up, and then it goes through the resistance 1. We have a high on this bar of, let me just draw this in for you, so it should be 167.76. Now if we go back to the daily chart, we can see that we had resistance at 166.76. So 11 pips higher, the market moved and then failed to stay there and then came back below, and that's not unusual. With a 76% resistance, the market will trade through it, convince you that it's going to stay, but if the next few bars don't actually stay above that, then you can expect the market to move lower. And in this bar you can see that the high is 167.72. I'll get there in a minute. And then we see the market trading back down, and the low of this bar is 167.75, and then the market, once below the R1, continues down to the overnight DP line there as well. So the most that was available on this trade yesterday, I'm just going to draw in the entry line so it's a lot easier. Just mark up the trade and then go to, we'll just get rid of this and then go to, whoops, not to data, to tools, to the pip measurement tool, and just measure up and get a broad figure there. We've got 36 pips available on this trade yesterday. So let's just get rid of that. And just remove this as well, just to remove some of the clutter from the chart there. So we've got a potential trade at the moment. Look where the scalp is, 167. Go back to the daily chart, and guess what? The 167 area is also a 62 from this low to this high. Now, this just gives you some sort of advance notice that should the market move lower in the 30-minute chart, that you could find the market getting some support. It's a psychological level, and we've seen what happens at psychological levels before, where the market will find support and trade through it. I think it was Monday's market view, if not Tuesday's. You have a look at the annotation and the narrative underneath the date, you will see where we talk about this. And again, if you just look at all of the psychological levels, you can see the market trading down to these sort of levels, struggling with the highs of these levels, finding support and then breaking through these levels. So the psychological levels are very important, and especially in combination with something like the fib retracements in the larger time frames. As I've said on many occasions in the market view, and I will keep iterating this point, that the bigger time frames, certainly if you just spend a bit of time having a look at them, certainly do show where the market's likely to trade to on an intraday basis. And the reason for this is because the pros use the daily chart. They may trade in the smaller time frames, but to know where the background of the market is, that's what they pay the analysts for. And they will meet each morning, talk about where the major resistance areas are, whether it's pivots or whether it's the psychological levels, and what they can expect at those levels. And certainly with the fib retracement levels, they play a fundamental part in any professional's trading. So having those same tools and as the pros gives you an advantage of wondering why the market stops at certain areas, and in particular up here. So again, this is why I point these things out for you, so that you can actually use them. But I'll do the work for you. You don't have to do it. Each morning I do point out the figures. All you've got to know is where the figures are, and as you become more adept, then you can draw them in yourself and use them yourself as well. You can actually use them in the smaller time frames as well to calculate where the market's likely to trade to. I mean, I know from experience now that the market moving higher to there is 76% of that move, because that's just how you get used to it. You'll probably see it's just traded slightly above it and then stopped. In fact, it didn't even trade above it. So again, this is what happens over time. You start to see these areas and think, oh, there's resistance, and it allows you to actually trade the markets more freely without the PTPs and the triple X's. But if you're brand new, you stick with the basics. They will make money. If you look at the trade results on the website in the member section, if you want it simple, just take the PTPs. But if you want to really take a lot more out of the market, then you can use these sort of tools to allow you to actually trade. And again, I will do a lot more on this as we move forward, throughout the coming weeks and months as well, just to give you those advanced skills that allow you to make more profits in the market. But at the moment, if you're brand new, and I know there's some brand new ones coming on board today, then stick with the basics. Go back and have a look at the live trading videos as well. There's plenty there, just showing you when we get these PTPs appearing on the screen, how to make money from them. The market view just gives you the bigger picture. I'll show you where the market's likely to struggle, as in yesterday. That's precisely what the market did, which would allow you to then make a more considered judgment on whether to collect the profits or try and hold the position as well. But yesterday, 36 pips off that, based upon what we actually looked at in the daily chart, that resistance area there. Okay, in today's news, you need to stand by your beds at 1:30. We've got non-farm payrolls. It's a biggie, and they're forecasting 151,000 on this figure. So again, expect some volatility in the market. If this comes out lower, then we can expect to see the pound to move lower, and if it comes out lower, expect the pound to move higher. So, but then again, a few weeks ago, the figures were bad and the Dow moved higher, and so did the pound. So you just don't know. But non-farm payrolls is one of the economic news items you don't want to be in the market when it's released. So stand aside. Unemployment rate also out, 6.6 forecast, same as before, which is slightly odd when they're considering that they're expecting an improvement in the unemployment rate. Well, there you go. So let's wait and see what happens. Okay, so we can probably expect the market to be quiet until 1:30. Just as yesterday the market was quiet until we had the release of the interest rates. And that's the only reason I'm saying that is because based upon the daily chart at the moment, we're stuck in this sideways range. So that's what it's sort of predicting at the moment. And that is, of course, unless there's some geopolitical news that comes out beforehand with Russia and the Ukraine or anything else like that will move the markets. Otherwise, it could be fairly quiet and sideways. Right, well, that's it. Your 10 minutes are up. It's also the weekend is upon us, and if the tabloid press is to be believed, we could expect to see some decent weather over the weekend. So fingers crossed they're not actually telling porkies for once, and we get a nice bit of weather. I will see you on Monday. Have a great day. As ever, thank you for your support. It's very much appreciated. And as ever, thanks for watching.